Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. Tonight, we're at Epicure, one of our favorite bars and restaurants here in Sarasota. John Mousseau and I enjoy this spot. They've reopened. We wanted to come and film a video here and support them. Action this week in the markets. What did we see? It reminds me of a poem. The market is saying, no, I will not go gentle into this good night. Very strong. We've had some weakness in some of the short-term momentum indicators. The market had every reason to roll over late in the week, but it stayed strong. We'll see what next week brings. The biggest thing we need to be concerned about as traders and investors is to stay flexible here. Right now there's a bull market in opinions. Everyone's got a big opinion. Market's going higher, market's going to crash, the economy's going to do this, the economy's going to do that. They don't know anything. They don't know anything more than I do or you do. Stay flexible, concentrate on industries and sectors, and understand that supply and demand will continue to run the markets. So this week, a little bit of good, a little bit of bad. Momentum has rolled over negatively from high levels. That's a concern. It was impressive Thursday and Friday, though, how the market recovered from down opens. So as you know, next week will be fun. In terms of what we're going to do next week, we're going to cover each strategy and lay out how we're positioned: equity, fixed income, cash. So we'll see you next week.
Hi everybody, it's John Mousseau. I'm the President and CEO and Director of Fixed Income at Cumberland Advisors. As my colleague Matt told you, we're here at our favorite watering hole, Epicure. We're being safe, we're wearing masks, we're doing social distancing, but we're really trying to support a great local business as Sarasota starts to open up. A little bit on the bond markets this week. Really 3 or 4 things I want you to take away from this week. 1, bond market's pretty much quiet. 10-year bond moved 3 or 4 ticks from 0.68 to 0.64. 30-year bond moved about 9 ticks, down from about 142 to 133 in that range. So not much movement. Jay Powell, President of the Fed, out front and center this week, said they don't want to do negative interest rates. We think that's very good. He did leave the door open and he said, not now. We don't think they want to do it for a couple of different reasons. It has not helped Europe, it has not helped Japan. The evidence of that is in their markets. It has more importantly not helped their financial systems, particularly the banks. So he clearly doesn't want to go there. Do rates drop to negative? We don't think so, but it doesn't mean that they don't. We don't have the perfect crystal ball. But in any case, he did lay that out there. On the muni side, kind of like what we had a few weeks ago, moving down to munis, probably 10 to 15 basis points lower, bumps and scales across the board. Big demand for deals, again. And you know, you think about it, it's running kind of counterintuitive to the fact that we have obviously issues with some credits out there that are sales tax oriented, transit oriented. We talked about MTA last week as an example. Those types of credits, you know, are challenged. However, water, sewer, electric revenue, high grade general obligation, big demands. And it's very easy. If you're getting 2 3/4 to 3 or change in a high-grade municipal security versus a 1.40 on a treasury bond or a 0.6 on a 10-year bond, the difference is very stark. I think the other point is that it's very important this week is you looked at the state of Illinois. It came to market, BBB- rated, clearly a credit with challenges, a state with challenges. We know all the stories, the headline stories. However, they came to market. 5% on the short end, 5.85 on the long end. big demand for the paper, even though it's triple B minus. Light years cheaper than the rest of the market. Not a credit that we would buy. However, the most important point is that they had access to the capital markets just like MTA did last week. That's an enormously good sign for the municipal bond market in particular. So we walk away from this week with a fairly docile treasury market, a very good municipal bond market, and a calendar that's starting to rise because issuers are looking out there and saying, boy, the demand is good, yields are stable, it's a pretty good time to issue some bonds. That's where we are. We wish you a great week and go out and support your local restaurants as they come on board.